Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope all is good. We're going to talk about rebalancing your portfolio. When is the optimum time to do this? So we obviously manage accounts here for clients, but they have other accounts like their 401ks and their TSP, and we can actually manage those as well. We kind of link right in there and just make sure everything's taken care of. And the question comes up, when should I rebalance? Now, this actually stems from a study that we did years back where we said, if you can't afford to put at the time, $6,000 into your Roth IRA, well, what's the next best option? So we studied every single thing, broke it down by the day, by the week. How should you do it? What time of day? And we figured out what the next best advantage would be. So this is just a likely or a natural extension of that. Okay, we're going to cover some things here. It's going to get a little geeky. Hope you're ready for this. The first thing we have to do is mock up a portfolio. And I didn't want to play favorites or make it seem like I was picking some mutual fund or whatever that was like doing really well. So I said, okay, we're just going to have this one static portfolio. This is how and I'm not saying to do this, but if you wanted to build a 60-40 portfolio, 60% stocks, 40% bonds, this would do the trick. And so we're using just Vanguard funds. It was just really easy for me to go think of them, pull them up, find the weighting and go, okay, that's a 60-40 portfolio. So you could use T. Rowe Price, you could use whatever you want. It really doesn't matter. Okay, the next thing that we've got to do is we've got to figure out, now that we have this portfolio, what is the series of rebalancing that we're going to do? So are we going to just do it daily? No, that doesn't make much sense. Are we going to do it yearly? Or are we going to do it based on how the portfolio moves? And here's what we've come up with. So I'll show you right in here. Okay. So we're going to say we rebalance quarterly, we rebalance once a year at the same time. We rebalance when the portfolio gets 10% away. In other words, maybe we were at 60-40, now we're at 70-30, and we need to bring it back to 60-40, right? And then we're going to say, let's just never rebalance. Let's just go 60-40 and throw it, caution to the wind and see what happens over a 30-year time period. Now, think about what a rebalance does before we get into this data. Why would you ever bother rebalancing? Well, there's pros and cons, right? One of the cons is that when you rebalance, what are you technically doing here? We had 60% stocks, and maybe we had some really good winners in there. And when we rebalance, we're cutting off some of those wins and putting them towards the stuff that didn't do so well. So we could technically limit our performance by selling winners to buy laggards, right? And so that's a con. One of the pros is that, well, if you were 60-40 and now you're 70-30, you're technically taking more risk than you want. And if we don't rebalance, well, if the market falls during that unfortunate time that you have 70% or more in stocks, you're going to fall faster than someone who had 60-40, or you're going to potentially have a bigger drawdown, which we'll get to some of that data here in a second. So the other thing I wanted to highlight is the number of rebalances, just so you could see frequency. If there were a cost to doing a rebalance, well, that might add up if you did this 115 times. If you do this in a taxable account, well, there could be capital gains or short-term, long-term capital gains that you might accrue here. There could be the spread between the bid and the ask if you're using ETFs or whatever. So there's some slippage there. So there are considerations here, and that's why I wanted to show 115 times, 4 times a year. Obviously, there'd be one rebalance a year. There were almost 30 years that we got. If you rebalanced every time there was a 10% drift one way or the other, that turned out to be 8 rebalances over a 30-year time period, or basically one every 4 years. And then, of course, never is never. Now, here's what that looks like. So let's start off by going through we're going to go each one of them. So 60-40 with a quarterly rebalance, we're looking at the drift. In other words, how far away did we get from our 60-40 split before we needed to rebalance, or the quarter ended in this case. And so the very bottom line is 0. So you could see through the 2008 mess there, which turned out to be a mess. We got wildly off track. We got a 12% drift there. The quarter ends and we rebalance back to 0. Right? So basically the average drift, if you rebalanced quarterly, was 1.32%, meaning you were at 61.32% and whatever the number is on the other side, right? So not too bad, and that's because of the frequency of your rebalancing. It keeps it tighter. If you did it annually, it's not actually much difference here. Every year we rebalance back to 0. You can see that. and we had an average of a drift of 2.29%. If we rebalanced every time there was a 10% drift, remember that one had the least amount of rebalances, one basically every 4 years. So our average was 4.4% drift. Why? We had more time in between those rebalances, right? So we had more time to drift further away, whether it was up or down. And then, of course, if we never rebalance, our average drift is 12.56%. We have drifted now up for the last 30 years. We've drifted 35% away from the 60-40 split. It's because we didn't do anything, right? So which one do you think performs the best out of all of them? Well, it might make sense, right? If you never rebalance, assuming we have our fits and starts, but the market's generally trending higher. If you never rebalanced, then you're slowly, potentially taking on more risk. Well, naturally, a 60-40 portfolio would do that. So if we look at the total returns here, the green line is your never rebalance. If you never touched a thing, I'm not suggesting you do that. Just stick with me. You would have outperformed all the other strategies. The annualized return, 7.14%. When you break it down like this, you're not that far off, right? And we used basically free funds here, so there's not really a cost component like there would be if you use like American funds or some more expensive mutual fund. So now you look at this and go, well, I'll just never rebalance. Makes it easier on me, right? Remember, you're taking more risk. So let's actually go to, well, I'll break it down by the year. I hope this is not too small. Starting on the left here, 2024, in a good market, remember, it was a good year, 60-40 portfolio, never rebalanced, yields you 16.86%. It is the outperformer for the year. 23, of course, those were two back-to-back years of 20% gains, right? So that outperforms. Notice it outperforms on the downside too. This is getting later in the life cycle of this 30-year window we're looking at. So drawdowns become more interesting because you now have a higher allocation to stocks. In all but two cases, it outperforms when you never rebalance, but it does outperform on the downside. There's only one time that I found, 2015, where it technically outperformed, right? It didn't fall as much there, okay? Now, looking at the risk metrics here, we won't go over all this. If you know what you're looking at, it's fine. But looking at the risk metrics, because what we talked about before, risk, reward, we just want to know the difference. Come on over to this here, your max drawdown. If you never rebalance, your max drawdown is one of the higher, although it's not that big of a deal, it's one of the higher ones. Interestingly, the annual rebalance had the best performance in terms of downside, less downside. I mean, it's still not that interesting. That's a big drawdown, right? But 35%. So that one does the best. Also, it does the best, although not by much, in what's known as the upside downside ratio. If you are a mutual fund manager, you are measured based on your upside downside ratio, among other things. What that means is you have a mutual fund and you have an objective. Let's say it's a 60-40 mutual fund. I don't know. And you're measured by your benchmark. Now, how much upside beyond the benchmark do you get when times are good? And how little downside compared to the benchmark do you get when times are bad? So if you outperform on the way up and then you don't fall as much on the way down, your upside downside ratio is higher. So it's important for those guys. Annual rebalance, basically 0.99% there. That one beats. So from a risk standpoint, an annual rebalance keeps you better off in line. And remember, annual rebalance, you're talking 6.77% annualized returns versus 7.14%, assuming there's no costs or anything. So it's really, if you're focused on risk and you're getting late in that 30-year investment window, you might switch to an annual rebalance, okay? Something to consider. Okay, so what's the best way to go about this? Well, you can see that some of it is probably personal choice. I take a different standpoint. So a lot of our clients are not retired. They're in what's called the accumulation phase of their life. They're putting money into their 401k and TSP and IRA and stuff like that. So I took a different approach and said, what if every time you put new money in, you use that money to try and rebalance? Don't touch anything else, right? So let's say you're 60-40 and the markets move and you're 61-39. And then your monthly contribution to your 401k goes in. Don't touch what's there, but use that extra $100, $200 to go and buy some of the laggards. then you're like 39.5 to 60.5. You're like something like that, right? So we call it the accumulation rebalance. As you're adding, you rebalance with the new money that you have instead of touching that other money. Now, here is the sort of drift look at this. If you started with a 60-40 portfolio, right? Let's start with the purple line there. And you're putting money in early on, it's very simple to keep your target at 60%. The trouble is, over time, you're contributing money, but your portfolio value is growing. Your drift is getting off. It becomes harder and harder for those new dollars to pull you back to that 60-40 split, if that's what your goal is. However, it's better than never rebalancing at all. You got a 73. So by the time you get to the end of the 30-year window, your 60-40 turned into 73, or your 60 turned into 73. Sorry, let's call it 74. So you didn't drift as much as if you never rebalanced. So I maintain, if we assume there's no tax consequence, you're doing this in like a TSP or a 401k. If we assume there's no transactional costs, which there's not, even a quarterly rebalance would be acceptable. Something monthly would not work out. You would break the rules essentially. If we assume there's no cost there, if we assume that there's no real slippage or cost or tax, then ideally, if you're someone who's saving in your 401k, IRA, whatever it is, you want to use the new dollars to rebalance. That's our default here. So we build our own funds. And when someone makes a new deposit, we don't go rebalance the whole portfolio. We use what they have to try to bring everything back in line, at least initially, right? So consider that if you're someone who's younger and trying to move through the years, right, and going that way. If you are not contributing, what would be the second best? You're letting this thing go on and on and on. I would say, I lean towards never rebalance, right? But I'm a risk taker and I'm not of retirement age, right? So I'm not, concerned at the moment. I suggest never rebalancing. However, wait until you get closer. When you get closer to your target retirement age or whatever, then what do we know? We want to shift to an annual rebalancing because the risk the risk to reward is in our favor at that point. And we have the least drawdown, the biggest upside downside ratio, and we're still with a healthy return there, getting to pull everything back to 60-40. So I hope that wasn't too much for you. We are a bit geeky here at Jazz Wealth, like to go through these studies every now and then because clients ask us those questions. If you'd like to be a client, go to jazzwealth.com. We'd love to work with you. We work with clients of all sizes. You don't have to be a gazillionaire to work with us. And hope you check us out, jazzwealth.com. See ya.